Hi, everyone. It's 1 o'clock, um, and welcome to our live product walkthrough and Q&A session today. My name is Yulia. I am a part of the customer success team. I also have my colleague Anu here to help me out today. Anu, say hi to your audience if you're
Hi,
here.
everyone. Yep. Hi, everyone. Thanks for joining in. So I just wanted to do a quick tech check to make sure if everyone can hear us and see our screen. If you can quickly put a yes or even a smiley face through your questions tab, that will be wonderful. You should be able to see it in the control panel. Just click onto the arrow beside the word question and a window will pop up where you can then type in and hit send, and this is exactly how you can ask us any questions throughout the session as well. Okay, thank you so much, Chris. Thanks, Ellen, and thanks, Laureen, for joining us and for confirming. Really appreciate it. Thanks, Julia.
Oh, that's wonderful. Thank you so much. And we can move on to the agenda today. I will go over some of our new and exciting features and updates, and I'll also be answering any questions you have about these features or anything else really. In order to spend a little less time on scenario setup today, as we would normally do, and spend more time on answering your questions, I will actually be reviewing a series of client scenarios from our very recent webinar that we held on October 23rd. We will compare these scenarios using our new scenario comparison feature, and we'll also cover some of other improvements. And another thing that I want to cover today is how to stay up to date with our new releases. This is something I'm actually going to start with. So why don't I take you straight to Snap over here? If you've been a user of Snap for a while, you've probably already noticed that our application is similar to a living and breathing organism that learns and grows. And we release improvements and new features quite frequently. So being aware of these changes is super important. And we do our best to communicate these changes to you through multiple channels. For example, here on the screen, there is what's new section. This little in-app message will appear every time you log in for a short period of time after we have some major release, something new and exciting for you to discover. So it only takes about 10 seconds to read that blurb. And just reading that will give you a rough idea of what changed. So if you're a user who hasn't opened Snap for a few months, check this out first and foremost. Okay, so when you can click Learn More, and a full article will pop up with more details. And you can actually, if you close it accidentally, you need to focus on something else, you don't really have time, you can close it. And it's still going to be there when you click on Help. There's What's New section, and it opens the full article for you. And you can read, this is one of our most recent ones, has pictures, visuals, sometimes we put videos in there as well. And clicking on this at the top will take you to our help center. If you want to put a bookmark or something, you can do that too. And actually in this help center, if we go to the home page here, we have a whole section called What's New. So if you think that you missed multiple releases, you can go here, you can look at the category, and all of these articles just to help you a little bit to navigate, we have dates in here when we released something. So again, if you had a break from Snap for a while, you can simply head here and check it out from the last time you've been here. Just reading even the titles will give you some idea of what to expect when you actually log in. Mm. And of course, obviously, all of you know that you can reach us at the phone number listed on top here. We're very responsive. We pick up the phones. We're a real human here, real people, hardworking people. So we pick up the phones. We answer your questions right away. You can also send us a message through the contact. That will send us an email, and we respond maybe like, I don't know, we respond right away, up to 2 hours, but it's there for you. Uh, Another thing you can do is you can actually register for the next Q&A session under the webinars, live support sessions, product walkthroughs. I don't know if you are aware or not, we are actually hosting these sessions like today, approximately every 2 weeks. We don't always send out email invitations like we did this time because these sessions are usually less formal than our webinars. And we also don't really want to clutter your email box, but we always post here registration links. You can come here at your time, anytime. Click register. For example, we have the next one already here, registration link available. Or you can simply come back and look at the previously recorded sessions and see if there is any topic that resonates with you. All right, let's switch to the actual topic of the day. So going back to Snap, I'm gonna close this. And today we will be reviewing a series of scenarios for Sophia and Daniel. Sophia and Daniel Cruz. If you would like to watch in detail how these scenarios were created, actually head to our webinar section, and it's right on top here, Unlock Insights with Customizable Scenario Comparison, October 23rd. The video is already embedded in here. I will also send you this link in the follow-up message to our session today. So it's there for you. Okay, let's see. Let's go to the scenario, and I'm going to start with base scenario. One thing I want to point out is these icons in the list of scenarios. It's relatively new. It's been there for a couple of months, these icons, but we haven't done a formal kind of announcement. We didn't advertise it too much, but these are shortcuts to scenario setup, planning pages, and client report. And for me right now, I'm going to click on the gear icon, so I'm taken directly to scenario setup. And Sophie and Daniel are 60 and 62 years old, residents of Ontario. And they are wondering if they are on track in retirement in 3 years. They also like to leave as much after-tax estate as possible to their kids. So we're trying to see if deferring their government benefits to later in life could help them with that. And it's one of our really common questions that financial advisors come to hear from their clients. So we're using it for our example today. And we will be able to answer these questions using our scenario comparison feature. So going next to general, A few things here that we're using. We're starting these projections in 2025, and there is a good reason why. First thing first, we are in November. So um, anything we would be projecting for 2024, um, it would take us a lot of work effort to kind of retrace some steps back for the client. Did they make the contributions they wanted to make? Trying to chase some previous numbers for the assets. And remember, everything in scenario setup over here, we expect you to use January 1st values or as close to it as possible. Now in November, I can use today's values for all of the assets and everything. Um, um, I'm going to have a small margin of error on how much growth they will gain in the next month, but it's going to be just super minor. And when I'm creating a long-term financial plan, I don't want to think about it too hard. So I'm just going to go with 2025. Now, retirement age, we put here for Sophia and Daniel what they asked. And look at the show projection until age, 98 and 100. So normally you would see here 100 and 100, like same number. But we reduced the projections for Sophia because she is 2 years younger, and we want to finish projections in the same calendar year. The reason we're doing that is because survivor analysis is not a topic of our conversation. I don't want to focus on how much of Daniel's assets is going to be rolled over to Sophia. Um, it's just not something we want to focus our conversation on. So I will make sure to end the projection in the same calendar year. In this case, I made Sophia and the projections 2 years earlier, but I could have made Daniel's to 102, for example. Both are viable options. Mm. Okay, inflation rates here, we are using projection assumption guidelines. If you're unsure, click on what's this, and you will be taken to an article that explains in detail what it is. These rates of return, they actually also projection assumption guidelines, but they've been adjusted down to take to account for fees. So if you hover your mouse over these question marks anywhere actually in Snap, you will get some pointers of what is expected. So this message here, if you read it in detail, it actually talks about the fact that the projection assumption guidelines that we're giving you, they are including fees that you need to take out to reduce these. Mm. And you can save them as defaults for all future scenarios. Okay, so I think I mentioned the most important parts here. To talk a little bit more about Sophie and Daniel. They have a retirement spending goal of $90,000. It's a combined amount for both of them. And they also have some additional expenses. Now, in here, they want to travel in retirement for about just over 10 years. We entered this. They estimate about $15,000 for travel annually. It's a joint expense. We will be splitting it 50-50 between them. The inflation, we kept it at general inflation because these prices, they tend to go up. And from age to age, we're using from age because it's going to start in the future. If this is an expense that's a recurring, something that existed before you created the projection, you don't have to use this column, okay? Um, and they also have gifted children. It's a one-time thing, so we put from age 65 to age 65. Um, they just promised their kids $50,000, not bothering about inflation, so we put the zero in this. And we want to highlight both of those on our charts that I will show you later, um, simply as for transparency, what these additional expenses are. Should they change their mind in the future, they will be able to see right away what it will do if we take out one expense versus the other. Mm. And Daniel has the same thing. He doesn't have any additional expenses on top of these joint ones. Mm. Okay, so the incomes are pretty straightforward for Sophia. She has employment income. It is being indexed for inflation for a couple of years. Um, okay, and she also has a pension that she will start as soon as she retires at 63. It does allow for some bridging. So you will see the amount a little bit higher before age 65. And after age 65, it goes a little bit lower. Mm. And Daniel only has employment income. All right. I believe their assets are also pretty straightforward. They maxed out their TFSAs and they have sizable RSPs and a small joint cash account, also a house. Going to look at the TFSA tabs over here. Always review them as you're working on the scenarios because you want to make sure to put adequate contribution room for them if you have this information. We know that they every year max out their TFSA contributions. So next year in 2025, they will have an extra 7,000. RSP, so we put a current contribution in there and it's converted to RIF at age 71, which is a default. Mm. Now I know that on Daniel's side, he also has a group RSP and he has employer matching on it. So I would go to this tab over here and we will make sure to link this to his employment income and indicate percentages, how much of his salary he contributes and how much his employer actually matches. So, okay, that's good. And their house is just their jointly owned asset, real asset here at the bottom. And if we go next, we will see our debt section. They have a residual leftover mortgage, really, with an interest rate. It's joined and it's linked to a real asset. Now, this thing, um, it's very useful when you're modeling a sale of a real asset in the future. If your clients intend to sell their home and maybe move into a retirement residence, or if you're dealing with younger clients and they want to buy a bigger house for a larger family, it is useful to link a debt to the property because as soon as it's being sold, this debt is being paid off right away if it's not already paid at that point of time. And only the remaining proceeds of sale are being introduced in your client's cash flow. Mm, but if we're not selling the asset, you don't really have to use it. Okay, another thing I want to talk about is this future start age column. Only use it if it's a future debt. Like, for example, if your clients are buying a new house in the future and they will be taking new mortgage to fund that purchase, put the future start age here. If it's an existing one, don't, because using this field will create an injection of funds and injection, sorry, of new funds into their cash flow as that mortgage will be taken. Mm. All right. Um, Government benefits for Sophia. In this base scenario, we're using just the defaults, the CPP start age 65 and OAS 65. And we have, they're receiving higher than national average just because they have estimated amounts. We entered them and it turned out to be higher than the national average. I think for both of them. All right, he has a little bit higher because he actually will be working until 65, while Sophia will stop working 2 years prior to that. Mm. All right, now all the other pages that don't apply to my clients, so I'm not going to spend too much time on them. I will be just going directly to planning pages. I'm going to make sure to be on the combined side to review this. And the thing that we do after we finish scenario setup is we are looking at this page from side to side and then top to bottom. So starting from side to side, we have year, calendar years over here just as a reference point, and we have their ages. And the retirement age is always bolded and underlined over here. And if you hover over it, it will actually tell you that this is the retirement age. Now we're looking further down here, we see expenses section. And these amounts are real and nominal base expenses. They are calculated leftover cash. It's basically the amount that the client has left in their hands from everything else that we entered in the plan. So it's crucial for you to actually look at this number over here and make a decision. Does it make sense? Like, because it's a really good thing, sanity check in a way. Does this amount sound reasonable for your client? And it's basically, we've taken the income, we deducted the tax, total tax and premiums, and we can see that there is a little bit CPP contributions and total tax. We expand the section. We also go over to the financial assets section and we see that they're making contributions to TFSA. This is something that was manually entered in the previous webinar, but they are continuing to contribute to their TFSAs over here. So again, SNAP took income, deducted tax, deducted the TFSA contributions and employee portion of the RSP contribution. It deducted the debt payments that they have and any other expenses you may have here, such as insurance premiums, for example. No, they don't have that. And then SNAP simply shows you the number, this $116,000. And in the years before automatic cash flow management kicks in over here, these amounts are assumed to be spent. So ask yourself, if the client tells you something unrealistic, that they're spending only $30,000 per year on their basic needs, on their budget, and you suddenly see this almost 120,000 here, ask yourselves, what are they doing with the rest of the money? Maybe they forgot to tell you about a bank account where they're saving it. Or maybe their budget is unrealistic and they never stick to it. So it's a really important conversation to have with a client when you see a large difference. Mm. Okay, so this is how we go side to side and now from top to bottom. We want to make sure that in this column, base expenses, that the values are consistent. So that you're not suddenly seeing any drops to zero. You shouldn't really, but things happen. Just review it visually. Make sure it makes sense. Everything is consistent unless you made it inconsistent on purpose. And you know why. You still remember why. This here looks good. We're also looking for any years highlighted with pink color, which would signify a shortfall. These clients don't have that, which is great. Another thing we're looking at is additional expenses. Do they start and end in the years we intend them to? And maybe we made an error in the scenario setup or something. But here, everything looks good. Travel in the first few years of retirement, a gift to children at Sophia's age 65. It's perfect. Hmm. We will also look at the pensions. We see that the amount, okay, so pension, if I hover my mouse over it, it will tell me that it's specifically Sophia's pension. And we see 35,000 in the first 2 years until she turns 65, where the bridging stops, and she receives a smaller amount of 28,000. So it looks good. And the benefits, she receives them, she starts them, give me 1 second. Okay, so smaller amounts. Daniel begins here, and then at 65, she joins him in receiving these benefits. So we see larger amounts here. So they also make sense. Basically, this is a really good review to show us that there are no obvious errors in this plan, and we can go further and look at the other scenarios. Oh, another thing I wanted to point out is if we look at the government benefits, we don't see OAS clawback column. It means that they never receive clawback, which is fantastic. But maybe, so this plan is actually not bad at all, but maybe we can make it better for them because they have their specific goals in mind. So we are going to the top of the menu over here. We will switch scenario to scenario number 2, defer CPP to age 70. And I'm going to do the same thing. I'm going to go to scenario setup first and straight to government benefits. In this scenario, we delayed CPP start age to 70. And there are several factors that play into the calculation of how much the client is actually going to be receiving over here. And if we simply deferred the start age without looking at these numbers over here, we might unintentionally introduce an error into our plan. So we really need to think carefully of what we're doing here. If your client is expected to work until age 70, until CPP start age, then don't worry about it. Simply change it and let the math do its magic and walk away. You will have everything projected perfectly. But we know that Sophia will stop working at age 63. So a certain adjustment needs to be made. And in this particular case, we reduce the percentage of maximum to 75% from 80. Um, it's to account for this enhanced portion that she will not receive because she will not be working, etc. I highly recommend you to go to the previous webinar that I mentioned, because my colleague Steve goes into a fantastic level of detail explaining how exactly he adjusted this value and things to consider when making those changes. Mm. And in this scenario, okay, moving on, old age security, we're keeping it 65. And the reason for that is very interesting. Um, I'm gonna explain it a little bit later, but there is a reason for it. So in scenario number 3, and I can go over here, I'm just gonna jump to planning pages. Just by clicking on scenario name, I'm taken to the planning pages for scenario number 3. These are breadcrumbs that show me where I'm at any time. Okay, and I'm looking at the benefits section. I'm going to expand it. And in here, we delayed both CPP to age 70 and OAS to age 70. So I'm going to talk a little bit about the reason why we would want to make a step-by-step approach when delaying the benefits. We want to see if there is a difference, like what would make more a higher difference in clients' estate values down the road, or how much benefits that they will receive if they delay only CPP, only OAS, or both at the same time. There might be some differences, and sometimes you might have a client who's on the verge of just not being certain and not being confident enough in delaying both. And you want to show them the impact of each of those. And we will be able to see that. Mm. Okay. So in here, we also want to look at the tax section, total tax and premiums. And look at the amounts over here. They're super small. For the first few years of retirement, they're really small. They pay barely any tax in there. So in the fourth scenario, and let me go fourth scenario, we are deferring both benefits, but we're also starting the RIF withdrawals earlier to take advantage of the lower tax bracket for the first few years and begin taking out the minimum withdrawals from the registered assets. It's another frequently used decumulation technique that we want to see if it's going to make any difference for our client. And to remind everybody how we convert RSP to RIF in SNAP, I want to show you that you can click on this financial assets title. You will be taken to scenario setup assets. It's a shortcut. And then click on RSP RIF tab over here. And as you scroll a little bit down, you will see this table and the conversion age. So by default, you will see age 71 here. We changed it to 62 for Sophia, 62 because RSP starts as of December 31st of the year the person turns entered age. So On December 31st of the year she turned 62, we convert RSP to RIF so that on January 1st of the year she is turning 63, we're going to start seeing the withdrawals from her account. And I'm going to show you them on planning pages. For Sophia, let's 63, age 63. Let's scroll all the way to the side to her registered account, and it's right there. I'm going to enlarge it so you can see. It's 12,000. This is the first minimum withdrawal from RSP account. And I can hover my mouse and just stay here for a second. It gives me a popover with additional information. It tells me that it's actually the minimum withdrawal amount. And it's 12,506, exactly what I'm seeing here. All right. So we have many scenarios to look at. And just by switching between them, we can get a lot of information. We can get a sense of what's going on, but it's hard. It's really hard to keep track of all of it. So I want to show you the most efficient way of doing that. And this is through our compare scenario feature. You will find it by clicking on the hamburger icon. And this is option called compare scenario. So for this one, just to start with, I'm going to look at the base scenario only. So I can, this is the column here called just to select. I'm going to select the base scenario, and I'm going to click compare selected scenarios. All right. What I have here right now is a new module that opens up. It's a very clean summary of my scenario and across multiple metrics on the left side here. And this list, it's a long list, it's customizable. On top here, I have an option to view information in nominal dollars versus real dollars. And I'm going to click on real dollars. Just today's dollars, it's visually more appealing to me. And when we're looking at these metrics, we see that they're divided into three categories. The first one, the primary, has things like lifetime expenses, personal tax, OAS clawback, if any. My clients don't have any, which is perfect. The second section is personal estate, and you will see how much they're expecting to leave to their children, if anything, and any tax on the estate associated with it. And the third one is corporate estate. So you see, not all of it applies to my client. Like there is a bunch of zeros. I don't want to see them all. So I can modify the list of these metrics by clicking on this button at the bottom. Select metrics. And I'm just going to remove anything related to corporations because my clients simply don't have that. I can uncheck the ones I don't want to see. And to uncheck the whole section like corporations, I can simply click this one here. Now I'm going to select show selected metrics, and boom, I'm only dealing with information that I actually want to see. If you would like, you can save this list of metrics for all of your future scenario comparisons by using this button, default menu. But if you ever get a client with a corporation in there and you don't see it on this list, don't forget to go back and maybe revert to original settings or reset it or add them back by hand. Okay. So we can, I think we're ready to compare all four scenarios. And I'm going to use this button because I now have a very nice and clean view. I'm going to select different scenarios and I'm going to select all others. And just remember, to be comparable, scenarios must be for the same people and have an overlapping range of years, meaning that it's possible to compare an older plan to a newer rebased plan. However, if the older plan didn't have a spouse and the new plan does, or it's a different spouse because your client remarried, which also happens, you will not be able to compare these scenarios. So you always need to make sure that you're comparing apples to apples and oranges to oranges. So don't be surprised if two scenarios can't be selected for comparison. Something is not right there. All right, so now I see all four scenarios side by side. They are ordered in the same order they were created. So base scenario, scenario 2, 3, and 4. And we do it for a reason. We don't want you to lose track of which plan was created first. So you can't change this order unless you recreate the scenarios in a different order. But trust me, it is good for you for keeping your sanity as you're working with multiple scenarios. And you can compare up to 5 scenarios. Here we have 4. And first thing first that we're seeing here is that the goal progress, which is a very valuable metric, it shows how much of your client's target spending is covered by their liquid personal assets. And we see an increase. So from 101% to 106%. So in the first scenario, they reach their goal, but barely. They don't really have much of a safety net of a surplus if something goes wrong. So it's a shaky situation here. It's not bad, but it's not perfect. Deferring just CPP to 70 is already making good improvement. It's taken us over 100% to 106%. And this increase is larger if we also delay OAS further. So it only gives us an increase of 2%. So for some clients who don't want to delay both of them, to defer both of them, you can recommend deferring CPP in that, like in this scenario, would make more of an impact than deferring just OAS. All right, and in the last scenario, it looks even better because, well, because we started the RIF withdrawals earlier. Somehow, we don't know why exactly, but this made our scenario so much better. Okay, and let's take a look at the expenses, retirement spending. We want to make sure that they're actually the same for these scenarios, lifetime expenses. If you see some discrepancy, try to ask yourself why and whether or not you can actually continue comparing the scenarios, because scenarios with drastically different retirement spending lifetime expenses, they would signify that your clients are living completely different lives, different lifestyles. So are they really truly comparable? Okay. Now, we also look at the lifetime government benefits and clawback. We want to make sure that there is no clawback. That's perfect. But we see how the total lifetime government benefits increases quite significantly the further we go with the scenarios. Okay, so It's good in numbers. Estate before tax is also a fantastic metrics because remember, our clients want to maximize their estate as well. And we can see in the last scenario, sorry, estate after tax is significantly bigger than in the base case scenario. But it's really hard to see in the numbers. So let's take a look at our second option called trends. And that's where we will see some interesting things going on. It might explain to us why we're seeing the changes. So similar to summaries, we have different metrics here. Base expenses, it just shows us that they're all the same, expenses all the same. But the personal tax, it looks already different. We see that just after retirement, and see how this chart is very interactive, we see how the taxes begin to deviate from each other. Um, some scenarios have lower taxes at the beginning and others have higher taxes later. And there is already, we see some differences. Hmm. No, corporate tax doesn't apply to us. Government benefits, again, we see how there is the base case scenario has an advantage at the beginning, giving us higher benefits because we started them earlier. But at some point, it just it doesn't keep up with other scenarios over here. And the personal estate, just give me 1 second. Financial assets. Let's just take a look at the estate after tax because it shows us clearly a break-even point. This is something that's very crucial to find as you are looking at different accumulation methods for your clients. So you see that the base case scenario, I'm going to highlight it by hovering my mouse over here. It has a slight advantage earlier in the plan, but at age 82 and 84, it actually becomes a worse scenario than the others. So you will need to have a discussion and actually think about before making the final decision about longevity of your client. Are they expected to leave past age 84, 82, 84 to take advantage of other techniques that we have? Or because more and more people are living longer than they expect, maybe it is better to actually go in with the deferring CPP and OAS. So I know I've been talking for a long time, but do we have any questions about scenario comparison so far?
Yeah, for sure. Thanks, Julia. I think it was a lot of information, but all very, very helpful for our clients. Just one question that I have, if you could answer, is what if we don't want to show the comparison until the end of the projections and maybe have a different time frame for to compare?
Okay, yes, that's a fantastic question. So if we go back to summaries, it's really good there. Um, we see that this comparison is actually built from 2025 to 2062. It's until the end of the projections for us. If you have something that you're wondering about, like if your clients say, I don't want to have projections until age 100, and maybe show me about at age 90, how it will look different, these numbers. So we're already seeing in the trends that there is a break-even point, but this technique actually will give you the actual numbers for that point of time. We are simulating ending projections in 2054 just with a click of one button. over here, or any point of time, really, going to 80 if we want to. It will change the calculated numbers below, and you will see that the shorter the projections, the smaller the difference is between the plans, until the break-even point, really, where they will start deviating again. So that's great. And I'm gonna just don't forget to move it back to the end of the projection, so you don't lose track of it if you forgot that you changed this. Mm, okay, anything else?
Yep,
I know.
thanks for that. Thanks for that, Julia. Another question is that how do we present this comparison scenario, and if there's a way to do it as a part of a client report or along with it?
Of course, we have a few options. We have these buttons on top. So to export scenario into Excel, you can simply click this button. It will generate an Excel for you. You can open it. It's a very simple spreadsheet that you can do whatever you want with it afterwards. Another thing here is, give me 1 second. I'm going to click on this. Okay. So the print, if I click on the print button, and actually it will open a print menu over here. And I will have the ability to save it as a PDF. So we have it separately from our client report now because we're more frequently asked to view this outside of a particular scenario. You're dealing with 4 here. So this is the most efficient way of doing that. But we can actually, in the client report, if we go to scenario number 4, and those are actually clickable shortcuts for you, we can go to client report for this scenario number 4 because it looks to be a preferable one. And in the report editor, we can actually go to report builder and use the filter snapshots only. And we can create a super quick summary of the report in 1 or 2 pages. And it will have all of the information needed for our client that we can present to them. So we will show them that we compared 4 different scenarios, and then focus just on the one that you actually want to recommend to your client by presenting them with the summary and explaining why you think it is better. And another thing you can do is actually, if we go back to compare scenario, you can disregard scenarios you don't want to show to your client. So let's select a different scenario. I'm going to unselect the 2 in between. And I'm getting a slightly different view, which I can also print out. It will show me first scenario, second scenario, and actually calculate the difference between them. So it only happens when you have 2 scenarios to compare against each other. It will put the things into a numbered perspective for your client. Just to build your case of one versus the other. All right.
Awesome.
Mm,
Thanks for that, Julia. Another question that have been quite often asked is, what are some of the ways to access this compare scenario feature? I know you did show it earlier, but if you could go back and show us one
mm,
more time, and also
perfect.
if you could show us how we can use one scenario and then copy it to then compare by creating multiple plans.
Perfect. Thank you.
Thank you.
All right. So there are a few ways. Um, number one, from the client's page, when you have a group of scenarios for the same client, you will have the numbered icon over here. Click on it, and there will be a button called Select Scenario to Compare. It's the same one we used. If we go inside a scenario, like let's just go with the base scenario, for example. And this breadcrumb menu on top, the little hamburger icon, gives us an option of what you can do with this scenario. Compare scenarios right here, but also copy scenario. So if you only have one copy right now, you can copy it, you can make changes to it, and it will be a brand new scenario. So see how it took my base scenario and put the copy in brackets? It's a completely new one. Clicking on that will allow me to rename it. Clicking on this little sheet will allow me to make some notes for myself, for the future me, to keep track of all of the changes I'm making. And clicking on client's name gives me a list of all of their scenarios. And again, select scenarios to compare. So it's virtually everywhere. Where you look, you can compare scenarios. Okay, I know I only have a few minutes,
Yep,
so I will be very, very quick with showing a couple of other things that we have.
absolutely. Yeah, yeah, please go ahead. Thanks, Julia.
Thank you. Okay, so very quickly, if we go to the planning pages, we can now we now have this column called rates for the debts, and let me just enlarge it. We can change them now. So before we could only do it in scenario setup, and we would need to create multiple mortgages that we have with different rates if your client is renewing or something. Right now we can simply, let me just move back. If they were changing the mortgage or changing the rate, we could simply click on this rate. We can change it to 7%, apply, and it will change all the way down. Another thing to note is as you're making changes, we have this run scenario button turning red. So we're actually changing it, most likely tomorrow, the day after. It will be orange. Orange so that you can actually easily connect it with the message we have here. When you're making changes and the scenario is changed, the numbers right now on the screen, they are not real until you click the button Run Scenario. So I'm going to click it right now. And it will apply the new rate over here. It will keep the 5% for the first and then 7% for the rest of the plan. Okay, another exciting thing is the charts. As you know, we recently started allowing showing all cash flow charts in real dollars, all of our charts. Only some of them had this option before, but now it's consistent across all the charts here or in the client report. And they're also kind of linked together. So you can select here and you will see it's in real dollars, current dollars. And I think last but not least, pay attention to these buttons on the planning page. Over here, we relocated and made some options more visible, like charts, recommendations. It's right front and foremost here. Stress testing, you can do historical or randomized scenarios. And needs analysis, it used to be in scenario setup. It now is moving over here for very good reasons because we are working on improving our insurance module and especially needs analysis. So stay with us as we're continuing improving and pay attention to the what's new section. And you reach out to us. I know, did I cover everything?
Yep, yep, you did. Thanks, Julia. We don't have any other questions right now, and I think we're almost at the time. So thanks for sharing and presenting our comparing scenario feature.
Mm-hmm. And if you sent us a question and we didn't yet address it live, We will be following up with an email with you, so don't worry about that. And yes, so this concludes our presentation today. Thank you so much for joining us. I respect that this was a lot of information. And should you want to review the recording of this session, go to our webinars, live support sessions. It will be under the category called selected recorded sessions. You will also receive an email, of course, but it will be here as well. And come to our next live product walkthrough sessions on December 11th or any other in the future. We'll be happy to have you. Thank you and have an amazing day.